Reliance Industries, India's largest company by market cap, a name every Indian knows. But what if I told you Reliance didn't grow the way most people think? Because this isn't just a company that got bigger over time. This is a business that quietly built an empire. Today, Reliance generates over 10.7 lakh crores in revenue, serves more than 500 million Geo users, and operates across four completely different businesses in under a single group. So the real question is, how did one company pull this off? Reliance started as a small textile trading company, but today it is India's largest company worth trillions of rupees. But the real questions investors should ask is Reliance still a good investment today? In this video, we are going to do a full fundamental analysis of Reliance Industries. We'll go through the business, we'll open the financial statements, we'll analyze the numbers, and then build a valuation framework to estimate what is the fair value of the stock actually is. No fluff, just structure analysis. So by the end of the video, you'll have a clear framework to make your own informed decisions. So let's get into it. Before we touch any financial number, we need to understand what Reliance is as a business, because this is not a simple company, and honestly the complexity is both its strength and a reason lot of investors find it hard to value. Reliance today operates across four core segments. Let me walk you through each one. Number one is oil to chemicals, which company calls as O2C, and this is where Reliance started. And they operate one of the world's largest and most complex refineries in Jamnagar, Gujarat. They take crude oil, refine it, and convert it into fuels and chemicals. And this is still a massive contributor to the revenue, but the margins are globally under pressure right now, and we'll analyze that once we get to the numbers. Number two is Geo. Everyone knows Geo. Geo today has over 500 million subscribers. It is India's largest telecom operator. But more importantly, Geo is Reliance bet on becoming the digital ecosystem. And think broadband, streaming through Geo Hotstar, enterprise connectivity, and potentially the AI infrastructure. The ARPU, that is average revenue per user, right now is 206, and that a single change in ARPU could add thousands of crores to the bottom line. Number three is Reliance Retail. With over 19,000 stores and 349 million customers, this is India's largest retailer by significant margin. They operate across grocery, electronics, fashion, and they're now building out quick commerce as well. The daily gross orders in quick commerce grew by 2.5x in just one quarter, and that business is scaling very fast. And the number four is new energy. This is newest segment and honestly the most speculative one. Reliance is investing heavily in solar panels, green hydrogen, and battery manufacturing. Revenue contribution right now is near zero, but the capex being deployed here is massive. This is Reliance long-term bet on energy transition, and it's something that doesn't show up in today's financials but could be a significant value driver in coming 5 to 10 years. Now, let's put some numbers to this. Total revenue for FY 2025 came in at 10.7 lakh crores, making Reliance first Indian company to cross 10 lakh crore in total equity. O2C contributes largest chunk of the revenue, but when you look at the profits, Geo and retail are becoming increasingly important. The mix is shifting, and the shift is actually most interesting thing about this company right now. So at its core, Reliance started as an oil and textile company. Over the decade, it became petrochemical giant. Then with Geo, it made one of the boldest move in the Indian corporate history, and it paid off completely. Now it's trying to do the same thing in retail and clean energy. The story is one consistent reinvention, and that what makes the company very fascinating to analyze. But the stories don't pay your returns, right? Numbers do. So let's open the financials and see what the numbers are actually trying to tell us. All right, so we are going to start with revenue first, then profits, then margins and cash flow. Don't worry if some of these terms feels unfamiliar. We'll discuss about those later. So first is revenue growth, which is top line. For FY 2025, the revenue was 10.7 lakh crores. That's roughly around 125 billion US dollars. Just to put that in perspective, that's larger than GDP of 150 countries. But one single year number doesn't tell us that much. What matters is the trend. So if we zoom out and let's look at the trend, so we'll find that Reliance has consistently grown in terms of revenue. Though the pace has moderated recently, which was in 25 was somewhere around 7%, and for the company of this size, it's decent. Now, here's what's important. Not all the revenue is equal. The bulk of Reliance revenue is still come from O2C, and then the business segment has contributed around 6.2 lakh crores. But the O2C is a commodity linked business. When global fuel prices move, margins move along with them. So the revenue number can look large, but the quality of revenue matters a lot. Geo and retail, on the other hand, contribute lower in terms of absolute revenue, but growing faster and with better profit margins. The mix shift from commodity revenue to consumer and digital revenue is most important thing in the Reliance long term story, and we'll keep that in mind so as we go deeper. Let's look at the profit. Net profit for FY 2025 was 81,000 crores. That's 2.9% growth year on year. Revenue grew by 7%, but the profit grew only by 3%. So, which is slower than the revenue, and that's the first flag we need to understand. The reason is simple: OTC margins squeezed, global fuel cracks spreads weakened, petrochemical deltas were under pressure. So, even though Reliance was selling more, it was making less per unit in its largest business, and that's margin compression is not unique to Reliance, but it's a global trend in the refining and chemical space right now. But here, on the other side of the story, Geo's profit grew by 22% to 26,000 crores. Retail profit grew by 11.6% to 12,392 crores. So consumer space businesses are performing well, and it's the legacy business that's pulling overall numbers slightly down. And this is actually really useful insight for valuing the company, because if and when O2C margins recover, the overall profit number could jump significantly without any operational change, and that's called operating leverage. We'll factor that into our valuation in the later part. Let's look at margins. EBITDA for FY 2025 was 1,83,000 crores. That gives us an EBITDA margin of 17%. Net margin was around 7.5%. For context, these numbers aren't particularly high margins, but here's what you need to understand about Reliance specifically. Reliance operate across different segments with various different margins. O2C typically operates around 8 to 9% EBITDA. It's a high volume and a low margin business. Geo runs at a significantly higher margins. As telecom once built out, it's a very profitable business. And retail is still in heavy investment mode. So the margins are deliberately kept thin as they expand. So when you look at a blended margin number for Reliance, it doesn't tell us the full story. What you really need to track is whether the high margin businesses are becoming a larger share of the total pie. And the answer right now is yes, slowly but clearly. Now let's look at one of the most important factor of fundamental analysis, which is cash flow, which is, I would say, which is even more important than profit, because profits can be managed but through accounting and everything, but cash flow is much harder to fake. Operating cash flow for Reliance is strong. The business generates real cash. And here's the context for you. Reliance spent 1,31,000 crores in capex in a single FY 2025 year. And that's $15.3 billion being reinvested back into the business in a single year. But now, capex at this level means free cash flow, that's operating cash flow minus capex, is under pressure, and the company is essentially reinvesting almost everything it generates into the same and then some into building like future businesses like Geo's 5G rollout, retail expansion, and now the new energy manufacturing. So if you ask me, is it good or bad? I would say neither on its own. It depends entirely on the quality of those investments it has made. So a company that spends heavily in high return projects, it's creating future value, and that's exactly what we have to judge here. And we will do that when we get to the management section. Uh, what I will say here right now is the capex cycle for Reliance is expected to start moderating. The 5G rollout is already done, and the new energy assets are nearly commissioning. So as the capex comes down, the free cash flow should improve meaningfully, and over the next 2 to 3 years, that would be happening. So this is the key assumption that we need to keep in mind when we go to the DCF valuation. All right, so the revenue and profits are done now. Let's look at the balance sheet, because a company can still be profitable but still be in trouble if the balance sheet is weak. A company may sustain losses, but the debt can kill business. Debt analysis. Reliance debt to equity ratio currently sits at 0.43, and that's not alarming. In fact, for a company of this scale running massive infrastructure capex, it's quite manageable. But here's the nuance that you need to understand. Gross debt is elevated because of all the capex we just discussed. However, Reliance holds significant cash and liquid investments, and once you net off that with the and you calculate the net debt, which is considerably lower than the gross debt. And this is an important distinction. Always look at the net debt and not just the gross debt. Debt is not that bad. The real question is whether the company can comfortably service that debt. That's why always check interest coverage ratio to understand how the company can comfortably pay its interest from the operating profits, and that the company is itself not struggling. Now let's talk about return ratios, and this is where I want to be completely honest with you, because this is one of the most uncomfortable part of Reliance story. Return on equity. ROE measures how much profit the company generates for every single rupee of shareholders equity. Reliance 3-year average ROE is approximately around 8.5. That is not a high number, but for context, a well run business should ideally deliver 15% or higher. Next is ROC, which is return on capital employed, is around 9.5%. It measures returns on total capital, including the debt. Given the massive capex cycle and the fact that new energy assets are not yet generating revenue, the capital efficiency metrics are naturally depressed right now. Now, is this a problem? Here's what I'd frame it. Okay, Reliance is in the middle of one of the largest complex investment cycles in Indian history. When you're deploying 1.3 lakh crores in a single year into business that haven't even started yet, even so, your ROE will look bad. That's just math. The real question investors should ask is, will these return ratios improve as the capex cycle ends and the new businesses start contributing? If yes, the current ROE is temporary and could be a buying opportunity. If no, it's a structural problem. And we'll build that assumption into our valuation framework later. Now, let's move on to the management and competitive positioning, because the numbers only tell us the half story. All right, so the numbers are done now, and let's talk about something that doesn't show up in any spreadsheet, but one of the most important factors in evaluating any business: the management. In fundamental analysis, there's a saying: you can have a great business in a bad industry and still do well if the management is exceptional. Reliance is a case study of that. Let's start with the obvious one: Mukesh Ambani. He has led Reliance over 2 decades now. Under his leadership, Reliance has transformed from a textile and petrochemical business into a diversified conglomerate spanning in telecom, retail, and now even the clean energy. But what I want you to focus is the capital allocation decisions he has made, because that's what separates a good management from a great management. And one more thing worth noting is succession. Mukesh Ambani has gradually bringing his children into business. Isha Ambani leads retail, Akash Ambani leads Geo, and this is a deliberate transition of the leadership, and is something long-term investors should be aware of. Succession in a family-led conglomerate is a of this scale is always a variable to watch. Overall, on management, the track record is solid. Capital allocation has been bold and largely value creating. The risk are the pace of spending and the execution of new energy. Now let's talk about competition, and this is actually one of the most interesting parts of analyzing Reliance, because it doesn't have one set of competitors, it has complete different competitors across different businesses, and that's the complexity of this conglomerate. So let's go segment by segment. First is telecom, in which Geo. So in telecom there are three competitors, right? Jio, Airtel, Vodafone Idea. And honestly, I would say this is just a two-player market where Vodafone Idea is just fighting for its survival. So the real competition is Jio versus Airtel. Now, Jio leads in subscriber count with 500 million subscribers, where Airtel has roughly around 390 million subscribers. But Airtel leads in ARPU, which is average revenue per user, is significantly higher than Jio's 206. Why? Because Airtel skews towards more premium subscribers. Jio has more user base on cheaper plans. So who's winning? It depends on what you're measuring. If you care about the scale and ecosystem, it's Jio. If you care about revenue quality and per user profitability, Airtel is actually ahead. Both businesses are strong, but Jio's scale advantage means that the ARPU improves through tariff hikes. The earnings impact is massive simply because of the subscriber base size. Reliance Retail. In retail, Reliance competes across multiple formats. In physical retail, they are unchallenged. No one comes close to their 19,000 stores. The competition gets more interesting in digital and quick commerce space. In e-commerce, Amazon or Flipkart dominate. Reliance Geomart has not made that breakthrough yet in a meaningful way. Reliance advantage is the physical infrastructure. They have a store network and supply chain that's that's these pure digital players simply don't have. The hybrid model using physical stores as quick commerce hubs is where they're placing their next bets. In quick commerce, specifically Blinkit, Swiggy, Instamart, and Zepto are the dominant players right now. Reliance is a late entrant, but their quarter on quarter growth is quite high, which is like 2.5x. And whether the question is whether they can challenge these established players or not. So this is an open question still. Next is energy, O2C, and new energy. So in O2C business, Reliance competes globally. The Jamnagar refinery is one of the most complex and sophisticated in the world. The competition here is not really domestic, it's global refining capacity and global commodity cycles. Indian public sector companies like IOCL and BPCL operate in similar space, but they are like domestically focused and like pretty much government constrained. So Reliance has a scale and complexity advantage that is very hard to replicate. In new energy, these are still very early days. The domestic competition company from companies like Adani Green, Tata Power, and NTPC Renewables. But Reliance approach is very different. They're not trying to generate renewable energy. They're trying to manufacture entire value chain, panels, electrolyzers, batteries, everything. If that vision executes, the competitive moat could be significant, and if it doesn't, it's a lot of stranded capital. Here are the three biggest competitive advantage Reliance has. First is scale. In every business they enter, Reliance goes in at a scale that no company can match. Scale creates cost advantages, negotiating power, and brand visibility. Second, capital access. Reliance can raise money cheaper and faster than almost any other Indian company. That means they can outlast competitors in a long capex battle, which is exactly what happened in telecom. And third is ecosystem strategy. Most of the people don't understand, but Reliance is everywhere. Geo gives them 500 million digital touch points. Retail gives them physical touch points. New Energy gives them an infrastructure play. Together, they are building an ecosystem where each business reinforces the other, and that's not easy for a pure play competitor to like replicate. But with all that said, competitive position is not static. Amazon is not going anywhere. Airtel is genuinely a strong competitor, and in new energy, the race is just beginning. Reliance has strong advantages, but no guaranteed outcomes. So, all right, we have now covered the business, the financials, the management, and the competition. And now we have a complete picture of what Reliance is and where it stands. Now we are going to talk about where the company is going and then build a valuation framework to answer that one question. Let's get into it. Now, let's talk about what it could become, because in investing, you're not buying the past, you're buying the future. And Reliance future is genuinely one of the most interesting stories in Indian corporate history right now. Let me walk you through four major growth themes that any serious investor in Reliance needs to understand. Theme number one is digital ecosystem and expansion. Geo is most obvious growth engine with a PAT of 26,000 crores at a 22% growth rate. The real game Jio is playing is ARPU expansion. They are at 206, Airtel is significantly ahead at 245. The gap will close through tariff hikes, through upselling the higher speed plans, through enterprise 5G contracts and digital services layer on the top of connectivity. Then there is the Geo Star merger and of Geo Cinema and Disney Plus Hotstar. And within 3 months of launch, it attracted 600 million users with 300 million paying subscribers, making second largest streaming platform in the world. That's not a small side of business. That's a media empire being built on the back of the telecom. And then there is Geo IPO, which is single biggest near-term catalyst for Reliance stock. Geo platform is expected to go public potentially the first half of 2026 and at an estimated valuation of 15 lakh crores. And when Geo lists separately, it forces the market to explicitly price each business. Think it this way: if Geo is worth 15 lakh crores on its own and the Reliance total market cap is 18 lakh crores, you're effectively getting O2C, Reliance, and New Energy roughly around 3 to 4 lakh crores for businesses which are generating an EBITDA of 75,000 crores, and that's crazy. Reliance Retail, it's playing a long game with 19,000 stores today, but the physical network is actually the foundation of something much bigger. Quick commerce is the battleground for the next 5 years in Indian retail, and Reliance has an advantage nobody talks about enough. They already have physical infrastructure, the stores, the supply chain, and the last mile presence. The consumer brands businesses across 11,000 crores in just its second year. That's own label product which carries significant higher margin, and than the reselling third party brands. As that mix shifts, retail margins will improve. Combine that with quick commerce scaling, and you have a retail business that could look very different and much more profitable in next 3 to 5 years. Theme number three is new energy, and that's a long game. New energy is where you need to have patience as an investor. The assets are being built. Module installations are expected to start generating power in 2026. Polysilicon battery manufacturing, green hydrogen, all of this is various stages of commissioning. Here's a simple framing for you. India has committed to massive renewable energy targets. Someone has to build the supply infrastructure. Reliance is positioning itself to be that someone, not just a generator, but as a manufacturer of the entire supply chain. If they execute even half of what they have announced, the new energy could rival Geo in scale within a decade. Right now, this contributes zero to the earnings. In 5 years, it could be a complete different story. Global expansion. One more growth angle that is getting a lot of attention recently is Reliance is no longer thinking pure domestically. Their reported deal involving Reliance to build America's first large-scale oil refinery in 50 years. Partnership with Google and Meta announced at the last AGM on AI infrastructure. These are early signals that Reliance is positioning itself as a global player and not just India's largest company. Put all of these four themes together, and you have a company with multiple growth engines running simultaneously. And it's also part of why valuing Reliance is genuinely complex. About key risk, and now I want to be very clear about something. Every investment thesis, no matter how compelling it is, it has risk, and any analyst who doesn't talk about risk is either not being true or not being honest with you. So let's go through the key risk of Reliance. Risk number one is O2C cyclicality. The oil and chemical business is fundamentally tied to the global commodity cycles: fuel, crack spreads, petrochemical margins, crude oil prices. None of these are in Reliance control. We already saw this play out in FY 2025, where Reliance O2C EBITDA declined 11.9% despite the higher revenue. And this is a structural risk, and that doesn't go away. As long as O2C is a large part of the business, Reliance earnings will have that cyclical element. Risk number two is heavy capex and free cash flow pressure. 1.3 lakh crore in a capex in single year. That level of investment means free cash flow is under significant pressure right now. If new energy investment takes longer to generate, returns than expected, which is entirely possible, the company could face an extended period of high debt and low free cash flow. That's not a crisis scenario, but it's a drag on returns. Risk number three is execution risk in new energy, green hydrogen, battery manufacturing, solar panels. These all are nascent industries globally. Technology is evolving fast, policy frameworks are changing, competition from Chinese manufacturers is intense. Reliance is making a massive bet on a space where the rules are still being written, and execution risk is the real and should not be underestimated. Risk number four, competition across all segments. In telecom, Airtel is not standing still. In retail, Amazon and quick commerce players are well funded and aggressive. In new energy, Adani is also building at a scale. Reliance has real advantages, but the risks are real too. Sustained competitive pressure across multiple segments simultaneously is a risk that needs to be priced in. Risk number five is holding company discount post Geo IPO. This is nuanced but an important risk. Right now, Geo sits inside Reliance, so investors who want Geo exposure buy Reliance stock. Once Geo as a separate entity, listed entity, investors can buy Geo directly. In fact, Reliance stock has already corrected 10% in 2026, partly due to this concern. Post IPO, the market may apply holding company discount to Reliance, and that's a structural re-rating risk. Let me put rough numbers to this. Sum of parts: Geo at 15 lakh crores, retail at 6 to 7 lakh crores, O2C at 4 to 5 lakh crores, new energy at 1 to 2 lakh crores, gives an net SOTP of roughly 25 to 27 lakh crores after adjusting a net debt of 1 to 1.5 lakh crores. After apply 20% holding company discount, and you land at a fair value of 20 to 21 lakh crores, and that's still above the current market cap. Next is succession and governance. Mukesh Ambani is 68. The transition of the leadership to the next generation is underway but not complete. Family run conglomerates of this scale face real governance questions during the leadership transitions. This is a low probability but high impact risk that a long term investor should keep in mind. Six risks. None of them are deal breakers on their own, but together they explain why the market isn't simply pricing Reliance at a premium multiple despite its scale and growth potential. Risk adjusted returns matter, and a clear eyed investor account all of these. All right, so this is the section you have been waiting for. We have analyzed the business, the financials, the management, and the competition. Then we went through the growth prospects and the risks. Now let's put a number to it. And before I do, let me be very clear. What I am going to walk you through is a valuation framework, not a price prediction. No model can tell you exactly what the stock will trade at. What a good model gives you is a structured and evidence based estimate of fair value. So you can compare it against the current market price and make your own informed decision. That's what we are doing here. We are using a blended model, four methods, each capturing different dimension of value. And let me walk you through each one. Method number one is PE based valuation. We are giving a weight of 30%. PE is price to earnings, is the most commonly used valuation metric. Current APS for Reliance is approximately around 61. The stock is trading at around 23 times to the earnings. Now, what's a fair PE for Reliance is? Here's what I think about it. The sector average for Indian conglomerates sits around 20 to 22x, but Reliance deserves a slight premium because Geo's growth profile and the new energy optionality. A fair PE of 24 to 26x on the normalized earnings would be sufficient. Assuming O2C margins recover, gives us a PE fair value in the range of 1450 to 1600. At the current price, around 1380 to 1400, the stock is trading below that range. So on a pure PE basis, the stock is slightly undervalued considering the earnings normalization. Method number two, EV EBITDA, which is we're giving a weight of 25%. EV EBITDA is the enterprise value to EBITDA. It's a better metric for capital intensive business like Reliance because it accounts for debt. Reliance EBITDA for FY 2025 was 1,83,000 crores. Current EV market cap plus net debt gives an EV EBITDA multiple roughly around 11 times. For a global energy and conglomerate peers, a fair EV EBITDA is typically 10 to 13 times. For Reliance specifically, given the digital businesses commanding higher multiples, a multiple of 12 to 13x is justified. That gives an EV/EBITDA based fair value estimate in the range of 1500 to 1650. Again, the current price is below this range. EV/EBITDA signals slight undervaluation at current levels. Next is DCF, we are giving a weight of 30%, and DCF is discounted cash flow, is the most rigorous method. We are estimating the present value of future cash flows and that the business will generate. This is where our assumptions about the growth and capex moderation becomes very critical. So the key assumptions that I'll be using would be revenue growth of 8 to 10% over the next 5 years and moderating to 6% thereafter. EBITDA margins improving gradually as O2C stabilizes and Geo and retail become larger contributors. Capex declining meaningfully from FY26 onwards, and the 5G and the new energy built out and phases out. Discount rate of 12% reflecting India's cost of capital. Under these assumptions, the DCF model gives us an fair value estimate in the range of 1550 to 1750. The wide range reflects the sensitivity of the assumptions that are used in DCF. Small changes to any factor could change the output significantly. The midpoint of the DCF range will 1650, again above the current market price. Method number 4, sum of parts, weight 15%. Finally, sum of parts or SOTP. This is relevant particularly for Reliance because each segment would trade at different multiple if listed separately. Geo alone is worth approximately around 15 lakh crores. Reliance Retail at a conservative retail multiple is worth roughly around 6 to 7 lakh crores. O2C at a commodity multiple is worth around 4 to 5 lakh crores. New energy is hard to value today, but even at a conservative estimate adds 1 to 2 lakh crores. Now let's add it up, and the sum of parts gives a total enterprise value significantly above the current market cap of 18.7 lakh crores. After adjusting for net debt and the holding company discount, typically around 15 to 20% for a conglomerate, the SOTP based fair value comes to roughly around 1700 to 1900 per share. Now let's build a blended fair value by putting all of these things together. So you know, no valuation model is perfect. Each method has its own limitations. So instead of relying on single method, we'll use a blended valuation framework. So we have already assigned the weights to different approaches, and we are now developing a blended model to calculate the most accurate fair value of the share. So our blended fair value estimates for Reliance Industries sits in the range of 1550 to 1700 per share. The stock is currently trading at approximately around 1400, right? So at current levels, the stock appears to be trading roughly around 10 to 20% discount to our blended fair value estimate. Now, I want to be very clear here. This is not a buy recommendation. This is just a framework. The actual fair value you assign to this stock will depend on your own assumptions. What this framework gives you is a structured starting point, a number grounded in evidence rather than just opinion. And that's what fundamental analysis is. Alright, so let's bring everything together. We have completed the fundamental analysis of Reliance Industries. Now I want to leave you with a clean and structured summary, because good analysis is only useful if you can remember it and apply it. So point number 1 is business quality. Reliance is generally one of the most complex and a well constructed businesses that are there in India. Four segments, each with scale advantages and an ecosystem strategy that connects digital, physical, and energy infrastructure. The quality of business is high. Point number 2 is financial strength. Revenue at 10.7 lakh crores, EBITDA at 1.83 lakh crores, debt to equity at 0.43, which is manageable, balance sheet is solid, cash flow are strong at operating level, The pressure points are free cash flow due to heavy capex, and the return ratios are temporarily depressed. Both of these are explainable and temporary. Point number three is growth potential. The growth runway is significant. Geo ARPU expansion, retail scaling into quick commerce, new energy assets moving from construction to generation, and the Geo IPO is only a near-term catalyst that could force revaluation of the entire group. Multiple growth engines running in parallel. That's not something you find in that you find easily in a single stock. And point number four is valuation zone. So our blended fair value estimates put the Reliance in a range of 1550 to 1700. The stock is trading around 1380 to 1400. Based purely on this framework, the stock appears to be in a undervaluation zone and relative to the fair value that we have calculated. But the gap appears for reasons like O2C pressure, geo IPO overhang, and high capex cycle. Where does that leave us? Reliance is a high quality business going through a complex transition period. The fundamentals are intact, the growth thesis is credible, the valuation at current levels appear to be reasonable to attractive depending on your own assumptions. The risks are real but manageable for a long term investor. I'm not going to tell you to buy or sell it. That's not what this channel is about. And frankly, it's not what good investing is either. What I will tell you is now you have clarity on this business than 95% of the retail investors in India. Use that clarity to make your own informed decisions. That's a wrap on our first deep dive. If you have made it to this point, genuinely thank you. And the fact that you did tells me that you're serious about understanding the business before putting your money into them. And that's what exactly the kind of investor this channel is built for. Now, I want to hear from you. Tell me in the comments and tell me one thing what you find most surprising inside from this analysis. Was it the Geo ARPU story? Was it the SOTP valuation, the capex cycle? Drop it below in the comments. I will read every single comment that I get. And the big question, which company we should deep dive next? Should it be HDFC Bank? Should it be Tata Motors? Should it be Asian Paints? Or let me tell like Bharti Airtel also. So just tell me like we'll do that. And vote this thing in comments. The most requested becomes our next deep dive. Fundamental analysis is not about tips and predictions, not about predictions. It's about understanding the company deeply enough to have your own conviction about before making decisions. That's what we are going to build it together, one company at a time. And I'll see you in the next one.